It works.
Hello, everyone. Sorry to interrupt your lunch, but I'd just like to get this rolling. I'm Nan Hee In, a freelance journalist and a member of the professionals committee that organizes these events. Thank you so much for coming to this talk. I just want to say a few things about our speaker. I'm sure many of you know our longtime FCC Silver member, Larry Lipsher, but in case you don't, I personally think Larry is arguably the most popular U.S. tax expert in the city. I'm not being facetious, but that might be the case in the club anyway. But amongst journalists, he is a sought-after American CPA, myself included, because he gives such delicious, colorful, uncensored quotes.
Ta-da!
And I expect that kind of enthusiasm today as he's going to talk about the latest tax reforms in the U.S. He was here last time in 2015, I think it was, and that talk was about FATCA. Now, I'm afraid it's just gotten a lot worse, apparently. Larry's going to talk about the recently enacted tax reforms under the Donald Trump administration and the impact this would have on expatriates at this side of the continent. And as usual, he'll give it in his colorful and very easy to understand delivery.
Not necessarily.
Not necessarily. Everything is uncensored. You're allowed to say whatever you want, Larry.
I will.
You will? Everyone, let's give a warm welcome to Larry Lipsher. Yes.
Okay. It's good to be back. Beware the Ides of March. Brush up on your Shakespeare if you don't know that one. Beware Trump tax. If you are a 10% or more owner of a foreign corporation, let me tell you, stay awake. You're not going to understand some of the garbage I'm going to talk to you about today, but it's going to impact you. Question: how many of you here in the audience today have or are a 10% or more owner of a foreign corporation, a Hong Kong corporation, a China corporation? Of those of you here, how many of you also have a domestic U.S. corporation? None. You might consider next year, one, you're the smart one. You might consider, after my speech today, looking into getting a domestic U.S. corporation to own your corporation instead of you, the individual, because there are going to be problems next year. Okay. Next question. How many of you here are old enough to remember or recall, I know Joel is, but how many of you recall 1986, the passage of the Tax Reform Act of 1986, and what happened with it? 1, 2, 3. Not many of you. Let me tell you something. In 1986, I was a 44-year-old fart, aged before my time, who was a year shy of putting my first kid through university, and I did not have that proverbial pot to piss in. Ronald Reagan's Tax Reform Act of 1986, because of the complete and utter chaos it caused, was a blessing to me. I financed 3 kids through university because of it. I loved it. 1986, the act was actually a year and a half to 2 years in the making. Once the November 1984 elections were over and it was apparent that there would be a Republican House, Senate, and President, in all earnest, the Republican Party started work towards a tax act. Only they discovered the equivalent then of the Tea Party Republicans wouldn't go along with it. So it became a bipartisan effort. Praise be Bill Bradley, hell of a basketball player, wonderful legislator, but Bradley had that innate ability to get up and speak and put people to sleep so fast it wasn't funny. That's why he never progressed any further. Anyhow, an act was passed. The corporations got screwed because the individuals wanted tax breaks. 2017, it wasn't a year and a half to 2 years, it was a 50-day process from the moment the House introduced its bill to the moment Trump signed it into legislation. At the 30-day mark, the Senate Republicans voted and passed their version of the bill before it went to conference committee. And guess what? That 469-page bill of December 2nd turned out to be just under 1,100 pages with official explanations on December 22nd when it became law. 1,100 pages versus 469 pages. Anyone care to guess where those additional 600 pages came from? Lobbyists. They had a field day. Marty, turn the page. Ta-da. Okay, I'm going to talk about the provisions that impact those who own foreign corporations. You've read everything right and left about everything else. This is the area that is absolutely frightening. There's going to be a one-time tax on previously unrepatriated earnings, retained earnings in your offshore corporation that you never paid taxes on. Is it right? Is it wrong? It's right, because everybody's going to have to do it, but the way it was done is horrendous. The IRS is moving to a quasi-territorial system, not a full territorial system, but a quasi-territorial system, and if you have a domestic U.S. corporation owning your foreign corporation, that foreign corporation has the innate ability to give you a dividend, give you, the domestic corporation, a dividend. And that dividend is 100% tax-free. But if your corporation is owned by you, the individual, no deduction. You're going to pay tax on that dividend. That's 2017. Let's talk about 2018. There's going to be a whole new array of phrases that you've never heard of before. And I'm not sure that I even understand what we're talking about. I'm sure you're going to have problems with it, but in the next year or two, start acquainting yourself with global, intangible, low-taxed income. There's going to be a minimum tax on that. Deemed intangible income. Net deemed intangible income return. Sounds like an additional tax return to me. We were supposed to have simplification, right? Some simplification. Foreign-derived intangible income, qualified business asset investment. Marty? Deemed repatriation. Code section 965 of the Internal Revenue Code has been amended. By the way, if you're taking pictures of the slides, prctaxman@yahoo.com. Email me and I'll send you copies of this, even with all the grammatical errors that I forgot to correct. It's okay, I have trouble, I can't speak English either. Anyway, deemed repatriation applies for the last taxable year beginning before January 1, 2018. I'm a small business corporation with a calendar year end. December 31st, 2017 is the end of my corporation. The prior year started January 1, 2017. All 10% or more owners, individuals and corporations, are going to have to account for their previously untaxed retained earnings. It's going to be a pro rata share going back to post-1986 deferred income. If your corporation, sir, is older than 1986, forget about 1985 and before. That's not going to be subject to tax. But presumably, you don't have the records going back prior to 1986. You don't have to worry about it. Okay, there's going to be a one-time measurement upon, and that date is the date that you're going to pay the tax or figure out the tax. Either December 31st, 2017 or November 2nd, 2017. Why November 2nd? Find out which lobbyist paid a hell of a lot of money to get November 2nd, 2017 in there. It's opaque. I don't know. Nobody has really raised those questions. Okay, deemed repatriation. You're going to pay a pro rata share based on two tax rates, either 15.5% for cash, accounts receivable, publicly traded commercial paper. You get the gist. You see this thing. Everything else on the balance sheet will be at 8%. The chances are your small business foreign corporation has just cash and nothing else. Apple, Amazon, Google, Microsoft, believe me, they got a lot of things on the balance sheet that are going to be taxed at 8%. What I am critical about is the fact that this act should have a ceiling below which there are different sets of rules that should apply to the foreign corporation. But they don't. Oh, the government is going to give you deemed foreign tax credit against some of the tax that you're now going to pay. Big deal. And this is the nice thing. If you've got to be stuck with it, you've got 8 years to pay it out. Now, with $1.5 trillion lost from the Treasury because of tax cuts, and approximately $500 billion going into infrastructure, the value of the dollar is probably going to go down over the next 8 years. So you're not going to be paying as much 3, 4, 5 years from now as you would be now. So don't worry about it. 1 through 5, first years, 8%. Year 6, you're going to pay 15% of your deemed repatriation. 20% for year 7, 25% for year 8. That's all that's really applicable to 2017. On January 22nd, the IRS issued guidance, 22 pages that I defy you to look at and tell me what the hell it means. 22 pages explaining that we, the IRS, will give you the new forms, we, the IRS, will give you the new instructions sometime this year. When? I don't know. But you got to file taxes now, file them now. Don't worry about it. File an amended tax return later on because there are bound to be some changes. This is truly an inequitable law. Okay, now we get to next year. This is what applies to all corporations after December 31st, 2017. As I said, I'm a calendar year corporation. I now fall under the new law. The new minimum tax is going to be based on GILTI, Global Intangible Low Taxed Income. Guilty. You're guilty and never proven innocent. How they come up with these coin words and phrases, I'll never know. But I'm going to read this off of the top bold-faced portion of this slide. Guilty is the excess of a controlled foreign corporation's aggregate net tax-tested income over its net deemed tangible income return over its net interest expense. Could somebody tell me what the hell that means? Okay. Tell me about it. This applies equally to large multinationals and small corporations. On February 21st, the American Institute of CPAs issued a 3-hour and 44-minute audio podcast done by the international partners out of Washington, D.C. of Grant Thornton, explaining this. This was torturous to listen to. And I have a suggestion to those who are handling prisoners at Guantanamo. Stop your waterboarding. Let them listen to 3 hours and 44 minutes of this tape. It's horrid. Marty? Can't drink, you got to change the tape. Okay. The other buzzwords we're talking about, net deemed tangible income return. Sounds like a return, and it probably is, only we don't have the forms, we don't have the instructions. Net deemed tangible income return equals 10% of the CFC's aggregated adjusted basis and qualified business asset investment over net interest. Once again, be aware of the terminology. Don't try to understand it because you can't in its current state. But remember, it's going to impact you next year. Next slide. Foreign-derived intangible income, the next one I'm talking about, the next phrase. This is going to help all domestic corporations. You, sir, can probably take advantage of this now. Everyone else here, consider a new domestic corporation. This is a provision for the deduction of 37.5% of the sum of its foreign-derived intangible income plus 50% of its guilty, subject to a tax income limitation determined without regard to the deduction. Those words, quote unquote, come from the IRS guidance. And the IRS guidance further goes on to say that effectively this is a 13.125% tax on excess returns on certain foreign-derived income. Only they haven't really adequately explained what the hell foreign-derived income is. Next slide. The domestic corporation's deemed intangible income means the excess, if any, of its deduction-eligible income over its deemed tangible income return. Another phrase you're going to have to learn for next year. Next slide. And there's a new code section, 59A. This covers most of the international provisions of the new Tax Act. I don't think that your corporation has had $500 million a year in sales average. Have you? Okay. Then you can go to sleep. You don't have to pay attention to this one, because this applies only to the big guys. As I said, why, when this law was formulated, didn't anybody consider the fact that the small foreign businessman no longer can wind up opening up a bank account if you're an American, no longer can do this, that, or the next thing? Why isn't there a ceiling under which a separate set of rules applies? Wouldn't that be common sense? But then again, when has the IRS ever made common sense? Next. Okay, so what does it all mean? Guilty means you're going to have a new minimum tax threshold. Guilty means taxpayers are going to be required to calculate their annual earnings and profits along with the QBAI and other amounts to determine whether guilty will result in an additional tax. Quote, unquote, from Grant Thornton, this could be a significant burden for many taxpayers. Many taxpayers? Every taxpayer. And this is the politically correct terminology. There appears to be a large incongruity between corporate taxpayers and non-corporate taxpayers. Oh, brother, is there. Those dividends received deduction, the 50% deduction of the new global minimum tax, 37.5% deduction of foreign-derived intangible income, all of these are available. All of these are available to a domestic corporation. As the information and guidelines comes out for this, determine whether you should transfer your ownership to a domestic corporation to avail yourself of this. But don't do it prematurely. Wait for the government to provide information and hope and pray that it makes sense. The IRS in 2010 had 21% higher operating budget than it does now. The IRS in 2010 had 30% more compliance officers in the field than it does now. What does that mean to you? That means that the system has broken down. That means that letters that you write are going unanswered. That means that you as an American citizen living overseas are discriminated against. What can I say? Okay, I'm going to, prior to ending this the way I have ended the last few years, I'm going to use a quote. David Rosenblum is the managing partner of Kaplan & Drysdale, a law firm, lobbyist firm in Washington, D.C. If all hope is lost and you've got a massive IRS bill due, I urge you to consider working with Kaplan & Drysdale. They're expensive, but they hire all the retired upper echelon IRS officials to work for them. And quite frankly, they're the only large law firm, lobbyist firm in Washington with enough guanxi to get things accomplished if you have battle with the IRS. I love this flowering language. The statutory language of the new provisions is dense and rife with rudderless jargon. I love rudderless jargon. Bewildering cross-references and new and unfamiliar terminology. Heroic efforts of staff to explain the provisions in declarative sentences have been helpful to some extent. To whom? But the lack of transparency that has consistently characterized the development of the legislation has not. Okay, I'm going to now end this in a 5-slide harmonica solo. And after that, don't worry about time limitations. I'm here as long as you guys have questions. I don't know whether I'm going to be able to answer them correctly. And I do know this. If any of you throw me a ringer that I can't answer, I will take a moment. I'll have a swig of double gold.
Double gold tequila.
And then I will answer. Okay, let's start on the next one.
Well done. Thank you very much. I'm going to open the questions to the floor, but I've got one first before I do that. I just wanted to know, what's your political bias in all this?
You stole it from Bruce. He was going to do that. Okay. First of all, before I go into my political bias, let me tell you, I don't care who the President of the United States is. I think that Twitter is for twits. Okay. Secondly, especially in light of yesterday's firing, I couldn't agree more with former Secretary of State Rex Tillerson. I think that Donald J. Trump is a fucking moron. Thirdly, as much as I belittle the man, remember this. He's responsible for promulgating a new tax act that is horrendous, that is ludicrous. But how can I fault a law that is going to provide my retirement funding over the next several years? I love it. And then let me end this brief statement by saying I'm proud to be an American citizen, where I have the right to sit down and criticize my government, criticize the leaders of my government. I'm a Hong Kong permanent resident. I live in China. I live in Thailand. I don't have that freedom without severe retribution to do that in Hong Kong, China, and Thailand. That's my answer.
The gentleman at the front. Yeah, that's
Hi, Ted Kavoris, associate member and client of Larry for 20 years. So criticize everything except your wife's cooking.
My wife, by the way, let me tell you, last year,
don't go there.
in January 2016, I finally caved in and got cable television while we were in Bangkok, figuring I'd let her educate herself on what the electoral process in the United States was like. But that had repercussions. She decided she loved Donald Trump. And I've got to live with that.
Tiansha, Mama Hoo. So what about these new regulations where we have to report beneficial holdings within the next month? Maybe you want to comment on that, because I found it to be very oppressive.
It is very oppressive, but remember this. First of all, you don't have to do your beneficial hold. You're on what you didn't realize. We're talking about the filing of the FineSen 114. The FineSen 114, FineSen stands for Financial Crimes Information Network. Listen to the words closely. Financial Crimes Information Network. Doesn't that sound like pro-crime? That's our government in action. Last year, FineSen people decided that they wanted your returns to be filed by April 15th. Only all other tax returns before extension are filed April 17th, and there were too many problems. So what happened is that last year and this year, they're not publicizing it, but you are automatically given an automatic extension through October 15th. But don't assume that that extension for this coming year is going to be the same next year. They're going to do away with that. That's what, oh, for the Hong Kong government. Only because, okay, yeah. I am not worried about anything that has to be reported basically to the banks. And this is how it goes through. Why? Because the banks are required to keep this information, especially on U.S. beneficial holdings, and now because of common reporting standards of the OECD for others. The banks are required to keep this information, but not disseminate it. The banks have to, yes. But not submit the forms. But not submit the forms. I wouldn't worry about it. I wouldn't worry about it. Okay. The fact of the matter is, the reason no bank here will open up an American account anymore, because they don't want to be involved with this. In order to be able to handle this, the banks have to have people who understand IRS professional terminology in forms. We have a language barrier throughout the world on this. And I urge people, file your form. File the W8BEN, file anything they ask for. And don't worry if it's incorrect, because the people who are reading it don't understand it either. Just file so you can say you've done it.
Any more questions from the floor? Any more questions? Oh, gentleman at the far back.
Yeah, Larry, we've heard a little bit about territoriality, and you've mentioned quasi-territoriality. Please explain.
Okay. If there were true territoriality, that's here, wait. I'll be able to say that much better after a swig. I don't know what they gave, but it's good gold tequila. Go and take it. Nobody will stop you. Gilbert will be mad at me, but what the hell. Okay. True territoriality is Hong Kong, where if it isn't if the income wasn't derived in Hong Kong, you don't have to worry about it. The United States, it's not true territoriality, because if it were true territoriality, I could issue myself a dividend and deduct it. But I'm not a corporation. You, sir, might be blessed with a domestic corporation holding your foreign corporation. Consult with your attorneys, your CPAs, see when they can figure out what the hell is going on. And when in doubt, take advantage of the new law. Because remember, in 2010, there was a higher operating budget than there is now. In 2010, there were more compliance officers. The IRS is saddled with more than it can handle, and the system is broken down. Unless you're showing a hell of a lot of income, they don't have the capacity to investigate. When in doubt, take a chance.
Wow. Take a chance, apparently. Any more questions from the floor? A gentleman at the far back.
Just curious, I want to get back to the politics. Are there any lawmakers in the U.S. in either party that are kind of defending the interests of expats? I mean, it seems like we're almost being criminalized increasingly. We can't open bank accounts. Is there anyone defending us? I know we don't have a lobby. No one.
The problem is, and I'll show you later on, I've got that 22-page undecipherable guidance from the IRS. The problem is, you've got democracy in America is under siege, because when it costs $4 million in the United States to run and win in a safe congressional district, you've got legislators who are spending more of their time going after raising funds than anything else. Democracy, American style, is by far the best form of government money can buy.
Any more questions? Gentleman front, and then this gentleman later.
Just like to dig a little bit deeper into, because taxation is a political issue. After the 2018 midterms, is it likely that all of this will change yet again?
No. The reason being, I think there's a likelihood of having a Republican House and possibly a Democratic Senate, a split party situation with a Republican president in a period of our age when there's no such thing as bipartisanship. I think it's going to take a hell of a financial recession or depression to get people working with one another again. I am very pessimistic about the future with taxes. And yet, as I said, it's providing my retirement plan funding, so how the hell can I complain?
Gentleman at the front.
Thank you very much, Larry, for your presentation. And you've spelled out several kind of landmines that are in store for corporate taxation and corporate accounting for folks overseas. What about for individuals who just simply are employees or independent contractors overseas? Any similar landmines there for
Okay,
them?
the only landmine I have is everybody's talking about the new $24,000 standard deduction for next year. Let's take a look. You're filing married, filing jointly. You have 3 kids. The current rate, at the current rate, you're talking about $4,050 individual exemption. You got 5 exemptions with husband and wife and 3 kids. That's 4, 8, 12, 16, $22,000. Add to that married filing jointly standard deduction of $12,750. That's $34,750 unless I've forgotten how to add. $34,750. Next year, no individual exemptions, just one standard deduction. Next year, you're going to get $24,000 standard deduction versus a total of $32,750 this year. You're going to pay more, the chances are.
Any more questions from the floor?
If there's anyone who has any question at any time, pigeonhole me. I'll be here for a while today. Email me. I don't guarantee I'll be able to answer it correctly, but I am happy to try. And as I said, consult your attorneys, your CPAs, ask them. If they don't understand this, tell them they damn well better start understanding it because they're going to have a problem otherwise.
Yeah, I also represent one of the individual filers, non-corporate. What's going to happen with the tax credits? Is there any changes for tax credits paid for taxes overseas?
That's a good one. I forget the answer. I'll have to look. If you email me, I will, this afternoon, tomorrow, I'll provide the answer because I have the answer. I can't even take a swig and fake that one. I'll be honest, I don't recall. But I will take the swig anyway.
Gentleman at the back there.
A quick question. Is the new tax changes affect any retirement income for people who qualify for start withdrawing from IRA and so forth?
No, there are no changes there, but anybody who has financial estate, look at the fact that right now you can increase, the gift tax and estate tax exemption have been increased from $5 million to $10 million, which means if you have monies that you want to give to your kids, and that's the problem, who wants to give it to the kids when they're living? It doesn't work that well. But if you can afford adequate financial planning and give some money away, that gift tax exemption increase will serve you well.
Any more questions? And if anybody wanted more information or a copy of your slides, because there's been a lot of technical code terms and rudderless jargon, how would they get access to that information?
prctaxman@yahoo.com. I'll answer. Maybe not immediately, but within a day or two, I answer. Don't try to get me on social media because I turn off all notifications. I belong to all social media. I hate them all. And frankly, I am seriously considering that my next telephone will be a dumb phone.
Thank you very much, Larry. And a token of our appreciation. Thank you.
Another coffee mug.
Another coffee mug. Well, this is your 8th one now?
No, I got a jacket last time,
Did you?
but I put these to good use.
Larry's going to be here for a few more minutes. If you have any questions, please come up to the stage and approach Larry. He's more than welcome to give you tax wisdom. Thank you, everyone, for being here today. Thank you.